Well, we know that a health pandemic is global in scope, and although this has not been called a health pandemic yet, it may yet get there, we are seeing a global in scope reaction function to the virus. As countries move to contain the virus, those actions in and of themselves are disrupting global economic activity. In that way, it is an economic pandemic that is suppressing global growth and could even push global growth outside of the U.S. negative in the first quarter.
Yeah, and I want to get into that. But first, you raised the vexing problem here for the economy, which is if you want to respond quickly to concern about a new outbreak before you have a ton of information, then you're going to do economic damage no matter what. And at best, you'll help if it's a serious outbreak. And at worst, you've shut everything down for no reason because it's only a mild garden variety one. I mean, what in this modern day and age, when we can shut things down, in the blink of an eye, what should authorities do? How should we be thinking about this?
Well, it really is a political paradox, right? I mean, you have to preserve human life first and foremost. And so, of course, you're going to overreact. And it's one of the things the IMF has already warned about is that the overreaction we're seeing is creating this economic pandemic, and it is suppressing global economic growth. It's got much more lingering effects because it also seeds the very fear that we don't want to create, the panic we don't want to create, but it then prevents people from going to public places when they might otherwise do that, from making a sale or going out to eat when they might otherwise. And those things are lost for good. They're not something that can just be recouped as the economy comes out of it.
So when you say that global growth could go negative, I mean, look, we say a global recession is if we're under 2% growth. It's really unusual, I think, for us to go negative. How negative, for how long? And importantly, what do you think it means for the U.S. for GDP? Because it seems like now this effect is going to linger on past the first quarter.
Yes, well, I say global growth outside of the U.S. So if you include the U.S., you get a little extra buoyancy in that because we are the largest economy in the world. And I do think we're going to see growth around 1% in the U.S. in the first quarter, snap back a little bit, but not as much as many are hoping in the second quarter, because I do think there are lingering effects. But, we've got China. It won't print how negative its growth is, but we know China is negative right now. We know that Italy is going to be negative. Europe's going to be flirting with negative numbers. Canada, our closest trading partner, is looking like maybe flatlining. Mexico struggling to recover out of a negative year last year. So you've got this sort of, if you look at 7 of the top 10 economies in the world, they could be negative in the first quarter or close to it, flat to negative. So that kind of momentum, sort of that headwind that we're facing, is undoing much of the tailwind that was created by over 40 central banks cutting more than 70 times last year to set up better growth this year.
That is my final question. What do you think then the Federal Reserve should do, if anything, in response to all of this?
It's a great question. Policy is not well designed. Clearly, fiscal policy can't do much until people go back to the stores and we actually have an event here in the U.S. In terms of the Federal Reserve, they have to wait and see, and that's exactly what you see them doing, monitoring. I was with them all yesterday at the NAPE conference, and they're all talking about monitoring things very closely, and it's because if things weaken enough, you do have to lower interest rates, one, to make sure the yield curve isn't inverted, but also to make it easier for companies with that triple B rating. Over 50% of all bonds issued out there are right on the cusp of being investment grade. Companies that are going to be hit by these losses are fragile in their credit conditions, their debt conditions, and so lowering the interest rate does help them a bit. And it also, of course, gives a little extra lift to things like mortgage refinancings. I'm not clear we can keep the housing market booming. There may be a pause if there is a little bit of a panic with the pullback we've seen in the stock market in the last. But these are the ways that you could have a little offset.
Sure.
But the problem is there's no silver bullet to this kind of a shock.
Yeah, no, that's for sure. It's amazing how quickly the growth numbers have been just axed by all this. Diane, thanks very much. We appreciate it.